Hi traders, this is Senior Account Manager Adam Howes hosting the webinar for today on the benefits of having high equity in trading. This is one webinar that we host as a series throughout the week on different topics in the market, and we really try to get the core of the things that matter in trading. We really try to address the important topics that we think are going to help you progress and obviously grow your portfolio. One of them, which is often overlooked, is actually the level of equity that you have to trade. More often than not, as we'll see in a moment, more often than not, the biggest challenge or any hurdle for any trader is to start out with the right amount. Now that can vary, but as we'll see, there'll be a number of factors that will influence that. So we'll get underway. Just a short general advice warning before we begin. The following education session is not to be treated as personal advice. ForexCT provides general advice only that does not take into account your objectives, financial situation, or needs. Trading FX and CFDs involves a substantial degree of risk and should only be undertaken with risk capital. Investors do not own or have rights to underlying assets. Okay, so we'll just backtrack a little bit here. Okay, so we'll start out with getting to the core of what it means to sort of think about equity in trading. And a lot of that comes around trading psychology. It's really important to remember in trading that there are no absolute guarantees and there's no such thing as a sure thing. The risk of Forex and CFD trading is quite high, and if we don't mitigate the risk or maximise our profit on correct equity, then we're putting ourselves in the boat of not likely to succeed. But just remember that the potential returns are also fantastic. There are many characteristics and skills required by traders in order for them to be successful. The most essential, in my opinion, is to form a solid trading psychology and not fall prey to the pitfalls of greed or fear or limiting beliefs. Now, when we look at negatives, trading psychology, it is largely fear-based. So the focus usually, when we're fearful, is we're focusing on losing trades rather than winning trades, and the focus usually is on desperate preservation of small equity. Now, ironically, in trading, this increases the chances of depleting the small amount of equity that you have. If you approach the market from a negative perspective, you increase your chances of making bad decisions and making emotional decisions, and therefore increase your chances of losing money. Now, negative does not mean you expect to lose, but you may have a lot of fear in your trading or not have fully accepted the risk of what you're doing. You need to take on risk in your trading, but you can mitigate the risk, and there's a really sort of important distinction there. Most successful traders adequately capitalize from the beginning. Now, the psychology largely goes from fear-based when you do this to freedom-based. And as we'll see in a moment, this offers a multitude of benefits to any trader with any experience level. So what capital is and what it isn't. Okay, so capital or equity is used to generate a balance between the risk and the reward of a trade and the role leverage plays. Capitalization refers to the amount of available equity you have to sustain positions in the Forex market. When you look at putting equity down for a trading account, it's really important to realize that it's not a fee. Okay, it's a buffer that you use, and it is risk capital, but it's how you utilize the equity and how you develop a risk management plan that matters. Often newer traders will enter the market with the expectation of building a larger account from a smaller deposit. Now, if this was possible, then everyone would be doing it. Obviously, if all it took was $500 to put in your account and start earning $1 million a year or whatever, then everyone would be doing it. Any desired return requires proportional investment. And if every trader was on a full-time income, as we said, from a small amount invested, then everyone would be doing it. The market is not the adversary. Okay, predicting market direction, in my opinion, is not the hardest part of trading. It's actually maintaining a positive trading psychology. Mastering your psychology in trading means having enough equity to sustain you in good times and bad times to build your portfolio. So it's important to remember that trading is a business. It's a marathon, not a sprint. So capitalization in the business of Forex trading. As we said, trading is a business and should be treated as such. And undercapitalization affects any business. Does it really matter how much you start with? Well, yes, it does. The area of money management is the most important area in Forex trading. And it's crucially important for you to be realistic about what to expect. How much equity you start with plays a crucial role in how much you'll be likely to follow a proper risk management plan. Now, most successful traders mitigate the risk and maximize profit. They overcapitalize and underleverage. Most unsuccessful traders do the opposite. They overleverage on insufficient capital. So there's a really sort of important crossroads for you at the start of your trading. Okay, obviously, as we said, fear-based trading is more about starting off with the least amount to try and conserve that amount. Is that the best plan to follow? Well, swinging for the fences usually isn't. If you start off with a realistic amount in the market and start properly mitigating risk on that larger amount that you may have in your account, you'll find that you won't fall prey to the pitfalls of fear and greed in the market as much as you would if you're trying to preserve $500. So let's have a look at some of the disadvantages of smaller balances. Now, before we go on, I really want to reiterate that I'm not saying that you can't trade with a small balance in the market, but I'm just drawing your attention to some of the challenges that you will face by starting with that lower degree of equity. Now, as we said, it is human nature to want to get the most from the least amount in anything, but this style of thinking in trading can do a lot of damage to your portfolio. Lottery style wins in forex are rare. Okay, they do happen, but many traders that start with small account sizes by using tight stops and massive over leverage can often sort of liquidate on their accounts. The goal of trading is not to get every trade right. Okay, obviously we can't. We deal with the market. No one has total control over the market, least of all retail traders. When you have a small balance, the focus tends to be on not losing trades rather than winning trades. This is an emotional decision, and emotions in trading are not good bedfellows. When you have a smaller balance, often you'll be tempted to use X amount of pips or X amount of dollars as a basis for a stop. Now, an arbitrary figure like that has nothing to do with how the market behaves. When you have a larger balance, often you can diversify your portfolio with a number of trades and hedge positions in the market. But with a smaller balance, you're going to find that actually quite hard. One of the most challenging things with a smaller balance as well, in my opinion, is the issue of margin. Now, margin will constantly be an issue in your trading when you have a small balance. Margin approaching 0% means that you're in danger of liquidating on your positions. Now, if a trader wishes to keep a trade open that is going in the wrong direction, then they will have to keep putting smaller amounts in just to stay afloat. Constant margin alerts or insufficient margin indicates that you as a trader have not created a balance between your trading equity, your margin requirement, your leverage, and the account capital. So, what decision do we make here? Do we start off with a small amount and then run the risk of, getting into liquidation and keep topping up by small amounts that we had originally anyway in our possession? Or do we use that amount that we might have had, the larger amount at the start, to fully, sort of avoid the risk of constantly putting margin in the first place? Now, it is a harder road to follow. It's a bit more of a riskier road to follow, but swinging for the fences doesn't necessarily lead to the best outcomes. Trading a small or undercapitalized account is much more difficult because large accounts are buffered against mistakes, unexpected losing streaks, and sometimes even bad trades. But small accounts have no such buffer. Large accounts can be used to trade any available market, but small accounts can only be used to trade markets with low margin requirements and low tick values. Large accounts, as we saw earlier, offer more flexibility, whereas small accounts are very limited in the trade management strategies that they can use. In addition, trading a small account has psychological issues that make it even harder to trade the account well. So, for example, as we saw earlier, when a trader knows that they can only afford a single losing trade before their account becomes untradeable, because they know it will no longer cover their required margin, the pressure to make profitable trades is enormous. Okay, you're hedging everything on one bet. You will get trades wrong. Okay, now what if it's that trade that you hedged everything of your small balance on? Okay, it leaves you obviously liquidated. You haven't learnt anything, and you haven't given it a sort of longevity and the business orientation that it needs. Now, even if a trader handles this pressure well, this might not be a problem. However, even the best traders can lose trades. We saw that earlier, and there is nothing that can be done to avoid losing trades. So this is something that we don't have control over, which adds to the psychological stress. If you lose a trade on a small account, the pressure will be to tighten the stop on the next one, and the next one, and the next one, and the next one, and that increases your chances of losing trades, which is a bit like a death by 1,000 cuts. So when we look at sort of available funds that we might have, most of us have money tied up in superannuation or bank accounts, but not in our trading accounts. Now, banks are trading your money. That's how they actually get returns. Now, essentially, you've got a massive entity, i.e. a bank that you might have savings in, that are investing in a variety of assets, namely currencies, commodities, exactly the sort of things that Forex CT trades. They're effectively trading your money, whether you know it or not. Now, our morning report illustrates nominal spending power and the powers of inflation that erode gains on earning interest on savings accounts. So most savings accounts barely scrape together, 2 to 3% interest, even lower. But the power of inflation is eroding those returns over a consistent, daily basis, year on year. So if we look at making a small amount on bank accounts and paying, the cost of living increasing nominally at 2 to 3% interest, then you're going to have a largely one step forward, two steps back scenario. Bank returns are a trickle at best. The potential returns you have in trading are much higher, and you have control over your decisions of who trades your money and how. So let's just take a look at a quick example. We've got trading example 1. We've got an account size of $500. We have a risk-reward ratio of 2 to 1. The risk tolerance is no more than 5% of the account balance per trade. Now, a trader wishes to trade a mini lot on the AUD USD. Okay, it's a 10,000 unit position. Now, because of the small balance, the trader instantly goes into defense mode to try and control the market with a tight stop to preserve the equity. Because their risk tolerance is no more than 5%, they choose $25 as a basis for the stop. Remember, that's $5 as a proportion of 500. Now, in a 10,000 unit position, this equates to a 25 pip stop in the market. Technical analysis, which is you should always use to place your stops, advises that a 40 pip stop is basically ideal. Now, the Forex market on any given day has a 70 pip range on the AUD USD. In this example, the price may retrace 30 pips before it ultimately goes up in the trader's direction, and it rallies 70 pips upwards. In this example, the trader has lost a winning trade by not trading with the market and proper technical analysis. The mentality has been to desperately preserve the small amount of equity that we have, not on winning the trade, which is what with the information the market is giving us. So ironically, the next time the trader trades, they're left bitter from the experience, and the mentality will be to reduce the stop on the next trade even less, which again will increase the chances of losing again. As we said, death by 1,000 cuts. On the second example, we have an account size much larger, 10 times more at $5,000. We have a risk-reward ratio, yet again at 2 to 1. Risk tolerance no more than 5% of balance per trade. Now, in this example, the trader wishes to place a mini lot on the AUD yet again, the same position size. Now, this illustrates a very important point firstly, because having more in your account doesn't mean that you have to trade more in volume. You can trade the same volume, but on a larger balance. Now, because of the adequate balance, the trader has flexibility to trade with the market on the required stop of what the market is telling the trader to do. Now, even on the same position size, the trader uses the adequate stop of 40 pips, which equates to $40 risk. This represents just 0.8% risk of the total equity, not 5%, as the earlier example alluded to. The Forex market, as we said, on any day has a 70 pip range on the AUD USD. The price again retraces 30 pips before it ultimately goes up in the trader's anticipated direction and rallies 70 pips upwards. In this example, the trader has won the winning trade because they haven't over-leveraged, but he has traded with the market and not used arbitrary figures based on emotional decisions. The trader can not only comfortably place positions on this pair, but hedge in the market on other pairs and diversify their portfolio and still be way within the overall risk tolerance. So there's abundant research out there if you research, optimal trading equity to show that the amount that you trade with can significantly affect your profitability. Traders with at least 5,000 of capital tend to utilize more conservative amounts of leverage with respect to the balance that they have to trade. Now, effective leverage means you could, for example, leverage no more than 10 times your account balance. So on a $5,000 balance, you would not leverage more than 50,000 unit positions. Since many traders are inexperienced in trading Forex when they start out, they tend to expose their account to significantly higher levels of effective leverage. As a result, this increase in leverage can magnify losses in the trading account. emotionally spent, traders then give up on Forex altogether or choose to compound the issue by continuing to trade in relatively high amounts of effective leverage. This becomes a vicious cycle that can damage your enthusiasm, which attracted you to trading in the first place. There's a bit of a study here from 2015. And it's taken from a very good resource called Daily FX, which shows proportionally over time how much your profitability can be affected by your account balance. And you can see on this graph here, the traders with balances of 5,000 and above were 37.37% more profitable compared to traders that had a balance of just, under $1,000. Now, many of these traders would have balances, I'm hazarding a guess, of around about 500, which is what the entry requirement is to trade Forex with Forex CT. Nothing wrong with that to get started, but have a think down the track about what you're trying to achieve. Okay, you got into it to build an income. Is it realistic to achieve a full-time income on just $500? Probably not. Having a larger buffer in your account ensures that you weather against the bad times, you enjoy the good times, you mitigate your risk, you maximize your profitability on your winning trades. So increasing my equity. If you increase your balance, do you have more to lose? There is risk capital involved, but if you use smart leveraging and smart risk management, you don't increase the risk overall because you're starting to leverage responsibly. The risk management is there. The mitigation is more effective. You risk less each time on your trades and you're able to diversify your portfolio, as we saw earlier. With this style of trading, you can remove negative decisions on emotional trading, and you can set realistic parameters on not trying to control the market. Just remember at the end of the day that Forex CT is one of the only brokers on the market, provides guaranteed stops and negative balance protection. So even with a 100K balance, you can be trading 50,000 unit position sizes and still manage your risk well under 1% with the ideal use of stops. So how much equity do you need? Okay, that was the only arbitrary thing I think of this webinar. It didn't give you sort of an amount that you should trade with. Well, this is totally dependent on what you're trying to achieve, your income goals, what your lifestyle looks like, I don't know, 5 or 10 years down the track. It totally depends on what you're trying to get out of this. Now, it's to make an income, a full-time income, obviously you're going to need more than $500. If you want to be in a position to try and make, I don't know, $1,000 a week or even $500 a week, you'd still need more than $500 to do it safely. If you're happy to invest in yourself, then we're one of the only brokers to come to the table in terms of supporting you to try and meet you more than halfway. We have a number of programs available to you that can effectively help you to start setting a proper risk management in place and starting to, really think about conserving your equity a little bit more safely and responsibly. We have credit arrangements. This is not a loan and non-repayable. It's extra equity that you can use to safely leverage on the market. We also have cost-saving measures in the way of rebates, premium spreads, and the SMS service is usually a service that you get with a balance of an account of $10,000 or more that gives you 2 to 3 daily alerts on economic events and trading setups. So, as we said, let's just cover the points that we discussed. The goal of this webinar is not to tell you or scare you off from trading with a smaller amount, okay? That's not the point of the webinar. Most of you probably came on with a smaller amount to begin with, okay? You can trade with any amount in your account. If the goal is to minimize your investment and learn the market, then that's okay. Lottery style wins are not impossible, just realize they are highly improbable. A trader that wins in a lottery style manner is most likely to be trading on emotions with no real backing of a concrete plan. That kind of trader is always equally able to blow up their account the next time they trade, okay? Just leaving it basically to the winds of the market, okay, and swinging for the fences. Optimal learning will come from correct leveraging or correct equity. So if you think you have any issues presented tonight that are relevant to your trading at the moment, if you think your Achilles heel may be your equity, then it will be ideal to discuss some solutions with your account manager and see what solutions are in place. Okay, there's no onus on you to do anything. You don't have to do anything that you don't want to do, but at least be aware of the solutions available to you and be aware of how to action them. Okay, because you never know, there may be a fantastic way to get you trading a bit more effectively with our help. So hopefully this has given you some things to think about, folks. Really appreciate your attendance today. As I said, this is one of several webinars that we host during the week, so we'll keep you updated on the homepage on other topics hosted in the market. For the time being, thank you very much for your attendance, and we look forward to seeing you at the next webinar. Thanks very much. Cheers.